we have to cover what caused the Nasdaq to drop into a bear market for only half an hour to only recover in the same session. We're going to take a look at the market, see what happened there, but also going to look at 3 stocks that are down more than 60% that might be a good buy in this market environment. Hi, if you're new here, I'm Robert. Welcome to my channel. Here we look at stocks from an unbiased perspective, looking at pros and cons to always find the best possible investment. If you like the content, hit the like button and subscribe. Okay, so what happened today? Nasdaq 100's wild session whipsaws from bear market to a rebound. The Nasdaq 100 index fell into a bear market and then erased all of its losses on Thursday in a volatile session that saw traders swing between fears on long-term impact of Russia's invasion to Ukraine and hopes for the Federal Reserve may be less aggressive in tightening policy amid heightening geopolitical risk. So yes, the traders especially, they don't know what they're doing or they don't know what they're supposed to do, trading in and out of stocks it seems. We opened up today in the Nasdaq heavily down. We were down more than 3%, which for the Nasdaq as an index is obviously really massive and affected a lot of stocks. So we were actually down. If you look at a list of stocks that I've put down here, they're looking up like massively at the moment, like especially some of the higher spec ones. But if you look at it more detail, the actual individual stock, we were actually starting off on a really low, but you can barely see it. So we were from 66 to below 60, and then we recovered in the same session. Like it was like insane. So started off the day below 60, but only for a few minutes to only recover now to and now we're actually up 7% on a stock like TDOC, Teladoc Health. And this is the same for all of these others. If you look at the graphs here, right, how this went up from all the negative, all down, recovered losses, and now they're actually up across the range, and only a few down, more like value plays that have been going up for the past recent days. They're a little bit down today still, but they also recovered some of their losses. But it's mostly the high growth and high speculative stocks that have been hit for, not just the past week or so, but the past 6 months or even more. They're up hugely today. But for that, we have to dig a little bit deeper into the history of how the market actually reacts to a war. I've brought up this article here I found on Seeking Alpha. They had a nice graph here. They're actually showing us how does the market react when there is some sort of shock event hitting them, because obviously what the market doesn't like is to be shocked and to be put into a position where it's an uncertain environment, where they don't know what is going to happen next, what are the political world leaders are going to do next, what is going to happen to my investment, how is that decision going to impact the industry or that particular company that I'm invested in. And that's why people get scared, people get feared, and then they drop out and then they pull their money out. So we can see that for a few things here. For instance, Iraq's invasion of Kuwait in the 1990s only dropped 1% in a day, but the total drawdown was 17% over the time of that invasion and over the time of that issue, taking 189 days to actually recover and take a total of 71 days to play out. So from the 1% down initially to the 17%, it took 71 days. But we have other examples here. For instance, the Cuban Missile Crisis from 1969 only took 0.3% down the market, and over the time of 8 days, 6.6%, and it took 18 days to recover. So we do have different reactions here, but I think what we see is that it might not be over yet, as we see that usually it takes a bit longer. We do have a few events here that actually only took 1 day and then only took a couple or more days to recover. So it's really up for guessing what this event is causing. Obviously, it's a very tragic event that what's happening right now in Ukraine. In terms of the market, in terms of the investing, this is sort of what the average here is looking for. So on a usual day like this, or an unusual shock event like this, the market draws down around 1%. The total drawdown around 5%, which we actually almost seen in the beginning of this trading session. And it usually takes 22 days and an average 47 days to recover to where it was before that shock event. Obviously, every event is different. Some of them are more tragic and more historical or have a bigger impact, such as the Pearl Harbor attack. Obviously, that was a huge event. So we expect this to take longer to recover from the World War II and all that. So you can't really pinpoint this on an average here, I guess. But it's a good indication to see, or just to look at the history to actually see what happened in these types of environments or events, to just prepare for the worst, so to say. Definitely see a further drawdown. But I think what we've seen today is the weighing up of investors basically saying, okay, there's a war coming, or there's geopolitical tension coming between US and Russia, and there's more issues on the horizon. Will this actually affect their interest rate politics? So it might actually be that they're now holding off on that because they're saying, well, we have to see what develops in Russia, and we don't want to get into a stagflation scenario where GDP is dropping or staying flat for the year. So they might actually hold off on raising interest rates for now, because the meeting will be in March, will be soon. So they will have to make a decision very quickly on that. So this is what's being weighed up right now by the investors so far. So it's interesting to see how the market actually reacts. And obviously we know the market is always forward looking. So they're already pricing in, okay, invasion happened. What happens for like in the next month or half a year? They're projecting what is likely to happen. So apparently on that reaction right now today, we are thinking that it might be actually positive for investments or stocks, because interest rates might not get raised straight away, keeping up the valuations or keeping the valuations higher of those especially high growth speculative stocks. But obviously, if we zoom out of that day, for 5 days we're still down 6%, for a month we're down 6%, for 6 months we're down 11%. For the year-to-date number, we're 17.5% down. Obviously, yeah, we had that bear market hit. So when you're down more than 20% from peak to trough, that's when you hit the bear market. We had that happening this morning for a very short time, for like 30 minutes, as I mentioned. So obviously, we're still down a lot from the peak that we hit in December time. So there's still a lot of deals, and we want to look into 3 companies here that are down more than 60%. This list here, which shows us stocks that have been falling more than 65% from peak to trough. It's a list of crazy companies. Who would have told me 1 year ago that this is what would happen? I wouldn't have believed it. I mean, back then in 2021, I remember how we thought that anything that's down 3, 4, 5, 6%, that's a huge buy the dip opportunity, and everyone jumped in with their money. And look at this now, we are down 60, 70, 80, 90%. So if you put your money into Clover Health at the peak of its price, you put in, let's say, $10,000, you lost 93%. You lost $9,300. Your balance left, your market value left on Clover Health would only be $700 from investing $10,000. A first look at this would say this was a really, really bad investment, because obviously if something goes down 90% in a year, it must be a bad company, right? So I don't think it's quite that easy. I think a lot of these names that are listed down here, such as an Affirm, HIMS, we have Zoom, we have Teladoc, we have Open Door, we have PayPal, Square. A lot of these names have been falling and have been caught up in this trajectory of high growth, probably loss-making companies, smaller companies that are just not the flavor of the market right now. Fintech has been falling like crazy, although they even make money, and other ones that are kind of unproven and new, or are a little bit small, like an Honest or Oatly, those ones have been falling just because the market is in this negative downtrend, while a lot of these businesses, the metrics and the business metrics and the revenue numbers and everything has been actually trending upwards. So I thought it would be good to look at some of those, to have a look at whether it's interesting to buy at these levels after these huge discounts that we've seen, or if it's actually justified that they are down that much. And we're going to look at Teladoc Health, we're going to look at Zoom and Block, which used to be Square. Let's go. First one on this list is Teladoc Health, TDOC, trading at $67.7 right now per share, actually up 10%. They were trading at the beginning of this trading session, they were trading under $60, marking it a new 52-week low. I mean, this stock has just been hitting 52-week low after 52-week low. Investors are really not liking it, as they relate it to a high growth, loss making and COVID stay at home type of stock. So let's look into this. So I pulled up one graph, the price to sales ratio, that we're gonna look at this one, because obviously they're still loss making, they're still in a growth phase. Although they're an older company, their growth is really happening right now. They've been put more into the focus since the pandemic hit, and since we're more at home, taking on more remote services as such. And since then, basically TDOC had this huge coming up. So during the pandemic, we've seen that they were trading richly. They were trading at 80-14 here, and then at the highs in the February 2021 season, we were trading at a 23 price to sales ratio, which was arguably quite overvalued at that time. But what you see now is trading at around a 3.8 price to sales ratio. When you compare this, if you ignore the whole COVID period, which arguably, yes, was a one-off period where everyone stayed at home and maybe used their services more. But if you think about it, a lot of people now use the services more than before, got introduced to them, companies took on contracts and made agreements with them. It's not that everything of that period is just gonna simply disappear. They actually moved forward a lot of business that they would have won maybe further down the track, once they made that transition, or once other companies made that transition into more remote work style, so that they're going into contracts with Teladoc for those remote telehealth solutions. So I think that a lot of that business, a lot of the growth that we've seen here, which obviously was a bit overhyped in that moment when it happened, but a lot of that growth here would still be in the revenue figures that we've seen today. And this is also this is what we've seen. I mean, look at the revenue numbers, right? From 2017, we only had 233 million. We're looking at a 2 billion right now. So we have in 4 years 10x our revenue. So impressive revenue growth. And the valuation is just, from in my point of view, if you think about where it was historically, so even before COVID, let's say, where they weren't even growing that fast, we were still trading at a 6 to 7 to 8 price to sales ratio. So this was before COVID at all. And that's just crazy to me that we're trading now at a 3.8 price to sales ratio, whilst we have actually much better revenue growth from percentage and absolute basis. We have more than 2 billion revenue. They're projected to grow another 30 to 40% next year. They're actually, in terms of the loss making, their loss gets smaller and smaller as we speak. Q4 just came out and looked pretty good to me. I mean, very impressive growth numbers, good gross margin, and the loss is getting smaller and smaller. So I do think there's a lot of long-term perspective here, and the price to sales ratio right now is just at an almost all-time low. So definitely a good deal for that one. There's a similar story to our next stock here, Zoom Video Communications, ZM. $122 share price right now, up 1.6% around that today, right now as it stands. Same here, I've pulled up the price to sales ratio to just pull us a bit in the perspective, like from where they were trading historically in the last 2-3 years that they have been listed. Obviously they also had the same sort of COVID related push and hype around them, where they were trading at a rich valuation back then. So we had a 62 price to sales ratio, from 62 to anything around the 40s. Now we're below 10. We're at 7.9 at the moment, also historically low. And if you think about, the same thing applies. So once you started using Zoom, or once your company starts using Zoom, it's not something you just get rid of just because COVID is over and the economy is opening up and everyone goes out. The companies all have their services. They're doing Zoom meetings all day long, every day. And also that, just because it opened up, we are still at a hybrid, at least a hybrid mode for most offices. And I've seen personally, I'm working from home all the time. And this is just a new environment that we live in. I think that that's never going to go back. people and employees, they want that flexibility. They want going forward to work from anywhere they want. So places like a Zoom, Airbnb, Teladoc, I think those are really, really strong places when it comes to a long-term perspective. So I think Zoom as well, looking pretty cheaply at these levels. And in terms of financials, we do have similar strong margins there. So around the 80% margin, obviously because it's software, so they can scale quite nicely. The revenue has obviously gone up way more than 10x since 2017. We're almost at a $4 billion right now, making already profit now. Net income more than $1.1 billion, so really strong. If you go back to here, we look at the valuation from a EV to EBITDA ratio, the enterprise value to EBITDA, so that to their net profit before interest and tax. We are obviously overhyped and overvalued, but as we come down here, the share price came down. Now we're looking at a 17 EV to EBITDA, completely fine for this type of company, given that the sentiment was negative, the stock price went down, but at the same time, all the metrics that we've seen, all the net income, the revenue, the gross margin, everything goes up, and not just slightly, but significantly, like exponentially. Look at these growth rates from 2020, even after the pandemic in 2021. We are from 600 million to $2.65 billion, and now projecting a $4 billion. So it's just impressive growth, and it doesn't seem to slow down even after the pandemic. I think this is a good future play. The next one on our list is Block X Square SQ, $89 share price today, slightly up 0.7%. Fintech has been hit especially hard in the past few months. We've seen valuations dropping significantly. Square was one of the darlings of the stock market, was always overhyped, always overpriced. I never really looked at it. I was never really interested because I saw this like huge run up, and then even during the pandemic, they had these huge run up, huge multiples all the time. But now since it came down and down and down, I've started looking into it, and I thought it would be a good long-term play, especially now looking at an EV to revenue of 2.8. I mean, this is insane. Like, they're growing their revenue so fast. And yeah, you're telling me that the 2.8 price to sales ratio is justified? I personally don't think so. And they are making profits as well. Obviously had a huge valuation. We're still looking at a 72 EV to EBITDA ratio, which is still high. But given that they're not really there yet in terms of the level of profitability they want to, we're still looking at a quite decent valuation. I would, for this one, although they're profitable, I would still use more price to sales ratio compared to a profit type of multiple, as they're still in a hyper growth mode. So most of that increase here actually comes from, well, the business itself, but also from the adoption of cryptocurrencies and dealing with Bitcoin. So they have a huge line of Bitcoin revenue, Bitcoin expense in their P&L. But nevertheless, we have really, really impressive revenue growth numbers, a solid business model with the Cash App, and being number one of the financial apps in the US App Store. So we do have very strong fundamentals here, a strong business that is cash flowing, while they've been renamed into Block to basically resemble the blockchain, crypto and Bitcoin world, similar to Meta for Facebook, what they've done, preparing the company for a transition into Bitcoin, into crypto, and using that app, the Cash App, as this cash cow, cash generating business unit that helping to fund some of those future projects and really interesting prospects that the company does have. And just to mention quickly why I don't show any like balance sheet or something, all of these companies have either no debt or manageable debt, have huge cash balances, so balance sheet is not really an issue. That's why I'm just showing revenue growth, price to sales, and EV to EBITDA ratios, multiples, to just give you a quick look at this. Is really interesting from a valuation point and from, you know, their future prospects. All of them have great futures ahead, so I do think it's worth a closer look for you. And this is how I want to end up the video as well. So hope you liked it. Let me know if you're invested in any of those three, or if you're looking at any of these other from that big list that I showed you before. And see you next time.